UK GDP grew by 0.5% in Q1 2019, after growth slowed to 0.2% in the final quarter of 2018. In comparison with the same quarter 1 year ago, GDP was up 1.8%, almost at pre-financial crisis annual growth rates. Despite evidence of slowing global growth and continued Brexit uncertainty, the figures show that the UK economy is performing robustly. Manufacturing grew at its fastest rate since 1998, rising by 2.2% in the first quarter. The substantial growth in the sector was, in part, a result of stockpiling, as businesses bought up supplies prior to the original Brexit deadline in March. The construction and services sectors also made positive contributions to GDP growth, growing by 1% and 0.3% respectively. In March 2019, however, the construction sector contracted by -1.9%, as both new work and repair and maintenance declined. The EY Item Club has cut its previous GDP growth projections from 1.5% to 1.3% for 2019, and from 1.7% to 1.5% for 2020. Despite solid growth in Q1, its downward revision for 2019 primarily reflects the prolonged Brexit uncertainty following the decision to delay the UK's exit from the EU to a flexible 31st of October deadline. Ongoing Brexit uncertainty, a weaker global economic environment, and forecasts that both consumer spending and business investment will slow in the near term are likely to weigh in on economic growth for the remainder of the year. Stockpiling activity is also likely to fade in the coming quarters, so the strong economic performance seen in Q1 2019 does not look sustainable for the rest of the year.
The UK Construction Purchasing Managers Index came in at 50.5 in April 2019, indicating that construction activity is still expanding but only marginally. April's figure, which beat consensus estimates, comes after 2 successive periods of contraction. April's PMI survey revealed that output expanded in the UK, driven by the fastest rise in house building so far in 2019, after a period of slower growth towards the end of 2018. However, both commercial and civil engineering work activity continued to decline. Purchasing managers also reported that new orders fell the most since March 2018 amid the ongoing political uncertainty, softer UK economic growth projections, and subdued demand for new commercial projects. April also saw business sentiment falling to a 6-month low. According to the ONS, London construction output fell by -2.2% in Q4 2018, with the all-work figure falling from 8.65 billion in the third quarter of 2018 to 8.46 billion in the fourth quarter. Infrastructure repair and maintenance, which was up 2.7%, and new housing, up 1%, were the only positive contributors to UK output in the fourth quarter. Output growth in all other subsectors was either flat or negative on a quarterly basis. ONS data for Q4 2018 also showed that London residential new orders came in slightly below the previous quarter, falling by -6% from 918 million to 861 million. However, this was still above the 10-year quarterly average of 725 million. London commercial new orders also fell marginally in Q4 2018 from 1.63 billion to 1.6 billion, a -2% drop. Despite recent weakness in UK commercial new order values, London is proving to be fairly resilient. On an annual basis, 2018 new orders in London exceeded both 16 and 17 values and continued their 10-year upward trend. Asian capital in particular is still looking to take advantage of the weaker currency and invest in London commercial property. A shortage of Grade A office space is maintaining strong demand for refurbishment and redevelopment work. However, given the commercial sector's exposure to Brexit uncertainty, development workload programs remain sporadic. The UK Construction Material Price Index for all work has grown by 4.4% in the year to March 2019, whilst the rate of material price inflation generally eased towards the end of 2018. Certain materials experienced accelerated inflation in early 2019 as oil prices rebounded. The cost of fabricated structural steel stagnated in Q1 2019, but was still up by 3.2% in the year to March 2019. Insulating materials, rising 11%, and imported sawn or plain wood, which rose by 7.5%, saw the largest annual increases. but the cost of the latter has cooled since December 2018, falling by -1.6% in the first quarter of 2019. Interestingly, the all-work construction material price index experienced a significant rise between January and February 2019. The index rose by 1.3%, which was the highest month-on-month increase in over 6 years, with the jump coinciding with the recovery of Brent crude oil in January of this year.
In terms of trade packages, we anticipate that M&E and facades will experience the highest inflation rates over the next 12 months. This is largely a result of high demand for skilled labour for M&E and increased workloads creating supply pressure for facades. At the other end of the scale, we expect demolition to see deflation in the range of -3% to -5%, with contractor pricing softening as they become keener for workload to fill spare capacity. Moving on to exchange rates. The pound strengthened in the first quarter of 2019 against the euro and the dollar, which may have helped ease cost inflation of imported materials in the period. However, sterling has since weakened against both currencies since the UK's decision to extend the Brexit deadline to the 31st of October. Throughout the remainder of the year, further volatility will be inevitable as the Brexit deal evolves. Providing we see an orderly Brexit with retention of open market trading conditions, G&T continues to forecast 2019 and 2020 tender price inflation for London at 1%. We then anticipate this rising to 1.5% in 2021 and 2022. If you would like to learn more about G&T's quarterly London market update or see our most recent tender price inflationary forecasts, please visit our GT Market Intelligence website.